Thank you very much. Good morning. Thank you for allowing us time with you today to share some insights and national resources with you. I'm Maureen Brown, Senior Private Banker at Fifth Third Private Bank. I'm joined today by my partner, Jane Marie Ray, Wealth Management Advisor, Sarah Williams, our National Risk Specialist, and Mike Nieders, our National Planning Advisor. Our topic today is protecting your personal and business wealth in unpredictable times. When we selected the topic months ago, we had no idea what March would bring, but it certainly underscored the unpredictable nature of life, the stock market, and banking. Now more than ever, selecting the right firm to provide advice to you, your family, and your business is critical. So how do you select the right firm to provide advice? You can certainly do your research online. You can look at the financials if it's a publicly traded entity, note how they invest and how they give back to the communities that they serve. Ask for references from clients they do business with. At Fifth Third, we're very proud to have been recently named as Ethisphere's World's Most Ethical Companies, one of only 4 banks around the world to receive this honor. Fifth Third Bank is a nationally chartered bank with clients across the globe on both the personal and business side. Fifth Third Private Bank is literally a bank within a bank, assisting clients and families with philanthropic strategies, business sales, customized lending, private equity investments and hedge options, as well as risk mitigation and generational planning. And now to share more about some of these insights from our clients, I'd like to turn it over to Jane Marie Ray.
Thanks, Mo. Maureen goes by Mo sometimes, so we'll use our nicknames here as well. So thanks again for having us. We hope it's a very productive hour-long conversation. We're excited to have our national resources, Mike and Sarah, and they come in our market quite a bit and work with our clients. So they are here. We'll have our contact information at the end. If you have any questions for us, their email and telephone numbers, feel free to reach out individually or to Maureen and myself. But we really do work with our clients to protect, preserve, and allocate strategically in times that are good and times that are uncertain. And we believe working with a team of advisors helps identify risk and ways to protect during those painful times. So we work with CPAs, we work with attorneys, we work with other trusted advisors to look holistically at what those risks are. And if I asked you today what you feel might be at risk for you, I think many of us would say inflation is a potential risk, stagflation is potentially a risk, recessionary risk, regulations, a low labor market, and perhaps personal health risk. And so those are things right now top of mind for a lot of clients and a lot of business owners. And these are all very valid risks. And this is what our planning and our risk management and what we deal with our clients to kind of help them through these times to handle these risks. But what's interesting is if you really think about 3 years ago in May of 2020, if I asked you that same question, what are you concerned about? What is your risk? You'd probably have a different answer to that question just 3 short years ago. It would probably be like, how long is the shutdown going to impact my business? How will I retain employees and pay for them? Will my business survive? Will we survive? And more importantly, how will we get any more toilet paper? So again, the questions 3 years ago are a lot different from now, and they'll be different in 3 years from now. And our point is, clients sometimes can be very myopic in what's going on right now for planning, and they want to talk about what's impacting us now. And we take a much longer approach. So we'll take a look at now, we'll take a look at midterm, and we'll take a long planning. What's going to happen? Business succession, life planning, turning over legacy to the kids, or maybe charity. And we think that's really important that advisors should be having that conversation and not just what you're going to be able to do today for allocation of a portfolio. And not all planning is the same. So a lot of times clients will say, gosh, I've got $5 million in assets and I've got a very complex family. We've got a lot of risk. So that planning may be a little more complex than someone that has $100 million and know they're going to give it all to charity and they don't have any loved ones necessarily still alive. So when you think about planning, it really is individualized. And it's very important to understand it doesn't have to be extremely complicated. Mike and Sarah work really well with attorneys, with CPAs. Again, we engage your whole entire kind of board of advisors. And we really think right now is a great time to really assess where things are at, and kind of take a breath and step back from what's going on and really think long term. Mike is one of our national planners. You see kind of across our footprint what high net worth people are doing, what business owners are doing, what they're struggling with. Can you share some of those insights on what you're seeing right now and kind of how you help those clients?
Sure, happy to do so. And thank you again for having me here today. Excited to be here and to be here on behalf of Fifth Third and our local team to speak with you. My role at Fifth Third is to work with individuals in the high net worth family wealth space, work with business owners and executives, in terms of understanding their personal financial goals and their goals for their business. And so again, we work closely with the team here and with Sarah as well on the risk management side. So again, excited to be with you here today. I'm going to speak specifically to a couple things, just our approach when it comes to wealth planning with business owners and with individuals and families that we deal with. Going to talk a little bit about taxes, fun topic here. Talk a little bit about taxes and how we plan, in terms of both income tax and then also estate tax. And then talk a little bit about estate planning as well, which I know Sarah has some comments around also. So again, as it relates to our approach here at Fifth Third and working with individuals and business owners, families, very important to identify goals and objectives. So to outline goals and objectives at the onset. So what are you looking to accomplish? What are you looking to accomplish, in terms of your personal goals and ultimately legacy goals as well? And there's a clear intersection in terms of personal financial planning and business planning or business succession planning. So ultimately what we're trying to help do is answer the question, what do I need to net from the sale of my business to meet my personal financial goals? So oftentimes when we work with individuals, in terms of succession planning, it's focusing on that top line, if you will. But really what's most important is what that net number is and what you ultimately need to net from the sale of that asset or the sale of the business to meet your personal financial goals. So we sort of work backwards and we work in three buckets. One is those lifestyle expenses. Again, so what do you need on a day-to-day, month-to-month, annual basis in terms of your lifestyle expenses to meet your lifestyle goals? Number two is taxes. So again, what amount would be allocated to taxes in terms of ultimately the sale or the transition of that asset or business? And then third would be legacy planning. So what component of your overall personal financial wealth, is dedicated towards what that legacy component is in terms of family or philanthropic planning? So again, working within those three buckets, identifying your goals and objectives, again, what you need from a lifestyle perspective, taxes, and then ultimately legacy planning as well. So there's an old adage in terms of planning and business succession planning, that the best time to plan for transitioning your business is when you founded your business, and the second best time is now. So again, there is a little bit of sense of urgency in terms of what that planning is, whether it's nearer term or longer term. A little bit about taxes. Okay, so two types of taxes, income tax and then estate tax. So in terms of income tax, when we're talking with business owners and ultimately the succession of the sale of that business, in terms of income taxes, there could be ordinary income taxes or there could be capital gain taxes. So there's a differentiation between a stock sale and an asset sale. So a stock sale would be attributed to capital gain taxes, which are more favorable and lower for a business owner. An asset sale would trigger ordinary income taxes, which inevitably are a little bit higher. So again, structuring that sale in terms of ultimately what that income tax liability would be and helping to plan for it. In terms of estate taxes, the current gift and estate tax exemption amount is $12.92 million per individual, or just shy of $26 million for a married couple. So any transfer that's made either during life or upon death that exceeds that exemption amount is subject to a 40% tax in terms of estate taxes. So right now there's a very high exemption amount, and we're working with a lot of individuals in terms of planning currently ahead of what future legislation is slated to be. So in 2025, at the end of 2025 and into 2026, that exemption amount is due to default back to what prior legislation was if nothing is done between now and then. That amount was 5 million, indexed for inflation, going to hover somewhere around 6.5 million. So again, current exemption amount of 12.92 slated to revert back and be about 6.5 million starting in the year 2026. So some planning to be done potentially between now and then. So we're working with a lot of business owners in terms of taking advantage of what today's high exemption amount is to transfer ownership in their business through potentially some vehicles, some specialized trusts to ultimately transfer that asset at today's higher exemption amount to ultimately save in terms of what the estate tax liability would be. And different ways that we go about doing that or helping advise upon, in terms of transferring business interests. Number one, it starts with evaluation. So what is the business worth? What is the asset worth? And in terms of how the business is structured, typically some discounts can be taken, if you will. Typically discounts for lack of control or lack of marketability, as they're known, can apply to transfer an ownership interest at a discounted value. So for example, if a business interest is worth 15 million, and again, through the valuation based on ownership structure, some discounts can be taken for lack of marketability and lack of control. Maybe that $15 million asset can be transferred at 10 million because of those discounts that apply. So now if we're talking about the exemption amount at just shy of 13 million, we can potentially transfer that asset with those discounts applied, either direct or via trust planning, into an entity that would be out of one's estate, again, at a value where we're using 10 million as opposed to the market value, if you will, of that asset at 15 million. So some powerful planning that can be done, again, via discounts and then via trust planning using, whatever entity it might be. It might be a spousal lifetime access trust. It might be an intentionally defective grantor trust. It could be a variety of different types of trust, but ultimately freezing the value of that asset, if you will, at today's value and the future growth of that asset, not only was transferred at a discounted value, but then the future growth of that asset escapes ultimate estate tax and grows estate tax free. Again, it's been transferred out of one's estate. So those are some of the techniques and some of the planning that we're doing with business owners. Philanthropic planning can certainly apply here. So if there's charitable intent, using a variety of different tools, it could be potentially a donor advised fund, a private foundation, any type of charitable trust, that could receive some income back to the individual or to the family, just depending on the situation. So each charitable vehicle has different timing and complexity, taxes associated with it. So it really just depends on the intent, and what sort of goals we're looking to accomplish. It can be very powerful in terms of, using a business asset, again, to satisfy some charitable goals, either currently or in the future. Again, as it relates to estate planning, so kind of piggybacking back to that. So ultimately trying to determine, again, what amount, we talked about those 3 buckets, is in that legacy bucket. So how do we best go about transferring in a tax efficient manner assets to either charity or to the next generation, to family, in terms of ultimately what that estate plan looks like. So what are the goals there? Do you intend to transfer business or wealth to the next generation? Does it make more sense to ultimately sell the business? So maybe it's a third-party sale and ultimately pass that liquidity to family. So understanding the options that one has, again, within the overall scope, depending on what those goals and objectives are. And certainly one's estate plan can change over time. So making sure that estate plan is up to date, is current, based on current legislation and based on what those goals and objectives are. So with that, I'll transition over to Sarah here. So, again, we work hand in hand in terms of what that estate plan looks like. Is there a taxable estate? Identifying some of the risks that might be involved along the way. And then ultimately, again, potentially utilizing some tools to help mitigate or even pay for what that ultimate estate tax liability is. So Sarah, I'll turn it over to you.
Thanks, Mike. Yeah, and as Mike mentioned here, on the estate planning side, we often will find that clients are going to have an estate tax situation, and they would like to make sure that their kids, their beneficiaries, aren't going to be either forced to sell the business or any other residence or anything like that. They just want to have the liquidity available. And one of the easiest ways and leverage wise ways to do that is through life insurance. So that is one area where we work with clients a lot as far as what is the most efficient way for you to pass on your legacy, whatever that may be. And so that's a lot of the things that Mike and I will work together on. He mentioned a spousal lifetime access trust. There's an ILIT, which is an irrevocable life insurance trust. There's all sorts of trusts. And really, life insurance is something that most people think of just for the basics, income replacement. I want to make sure that the mortgage can be paid off. But there's so much more that you can do with life insurance when you use it as a strategy. And that's really where I come into play is, what is your goal, and what is your goal today? And what is your goal, if you live to be 90 years old and pass away peacefully in your sleep, what is the best outcome looking back? So I actually start at your end goal for my goal as far as structures and planning and things like that. One of the biggest areas that I will tell people, I hear all the time, I have life insurance, it's fine, it's set. And one of the biggest things I would tell you is to have a policy review. It's something I do regularly with clients, and not every time, but often find that there could be a tweak made within that policy to make it work more efficiently. It could be a dividend change. It could be that your goals changed from the time that you originally got the policy. And at that point, it was income replacement, but now it's not. It might be that you wanted to receive retirement income from it later in life, and now you don't need that. The policies are structured for what the initial goal is. So as those goals change, it's important for you to make sure that policy is following to do what you need it to do, and that it will be there and be in place for you when that time comes. So a policy review is something that's a very simple process. It doesn't cost anything to do. And it does allow us, at the very least, if I come back to you and say everything is working the way that it should, that's a great thing as well. So I have an example that I would give you for a policy review that I did for one of my business owner clients who came to me and said, I'm going to surrender this policy. I no longer need it. And when we got it, it was to make sure that bills could be covered, mortgage could be paid off if something happened to me. I don't need it anymore. Well, the background of this particular family is they are going to have an estate tax situation when they pass away. And so my question to him was, why do you feel that you don't need it? And why do you want to surrender this policy? And so I don't want to pay the premiums anymore. And so I said, if we could take away the premiums and still have the policy in place, would you be interested? And he said, I didn't know you could do that. So what we were able to do was actually take the cash value from his existing policy that he no longer needed the cash value for, and reposition that into a different type of product that worked more efficiently for death benefit. We got him $1.2 million more death benefit and no more premiums. Now we've been able to reposition that from his name into the name of an irrevocable life insurance trust that is now going to be outside the estate. Hopefully, assuming he doesn't die within the first 3 years, because there's a 3-year period there. But ultimately, we were able to put it into the trust to now serve his new purpose and his new goal, which is to help avoid estate taxes or to help pay for the estate taxes that his family's going to face. So just that simple process of going through and doing a policy review has now made this client very happy. It has helped protect his family. And so that's just, again, something I encourage you to always have those policy reviews. I joke and say we go to the doctor every year for an annual physical to make sure everything's working the way it should. It's the same thing with the life insurance policy. Let's make sure that it's working the way that it should. When we look at the business owners and the business side of things to consider, there's a lot of different areas where life insurance can play a part of that. Obviously, there's the key man insurance or buy-sell agreements if there's multiple partners. It's important to make sure that those are structured properly, to have the buy-sell agreement in place and then have that funded properly. The key man policy, most people will tell me that they are the key person, which is absolutely valid, I'm sure. But think of who else might be a key employee, that if something happens that they were not able to come in and they were no longer there, how would that negatively financially impact your business? And that might be, you need to have a policy to help find somebody else to cover that role. But to keep in mind that while you are certainly a key person, who else might be as well? The other side of it too is how do you retain employees that you have that are key employees, and how do you attract others that you're trying to get in? You know that it's can be tough to get people signed on to work for you. What are some of the things that you can do there? And some of those things can be through life insurance, like an executive bonus plan, deferred comp, things like that. So again, life insurance can certainly play a part in that. And another big one that I come across, I won't say regularly, but a fair amount, is family business owners who maybe have 3 kids and 2 of them are in the business and 1 is not. When that business owner were to pass away, their goal and intent is to pass it on to those 2 kids that are in the business. But how do you make it, it equal or whole for the one who is not? And a way to do that is that you can have a life insurance policy. It's what we call estate equalization. So now the 2 that are in the business, they're going to get that. They don't have to sell anything to then be able to pay the third child in that scenario. So again, just something to think about there. That's beyond the typical kind of need that we think of for life insurance. Another one that we see that can really impact is business valuations and making sure that those are kept up to date. I'm going to give you an example of one that I had not too long ago that was here in a southern part of Ohio, but it was 2 partners. They started a business. Their goal really at the time, as most business owners, is just to get it off the ground and going. They did a business valuation a long time ago, and it was worth about $2 million. Fast forward, the business was very successful. It was now worth $20 million, and one of the business owners passed away. They had not updated it in that time frame, and the wife, the spouse of the business owner that passed away, only got the $2 million. She took them to court to try to show, well, it's worth 20 million. And unfortunately, the court says, but you had everything in place. You did the business valuation. Everything was done the way that it should have been done. It's not my responsibility. It's not the court's responsibility to make it up to the 20 million. So unfortunately, in that situation, the spouse lost out on a very large amount of money that should have been paid out to her had that business valuation been kept up to date. So something to think about there as to why it's important to keep those business valuations up to date. And the last one I'm going to talk about, I've already killed you in all of these scenarios, so now I'm going to move on to just disabling you with long-term care insurance. And it's not a fun topic. Nobody likes to think about long-term care insurance or dying for that matter, but these are all topics that are extremely important. With long-term care insurance, I won't get into all the statistics, but clients or individuals 65 and older, there's a 70% chance that you'll have a long-term care event. I'm not here to tell you that you can or can't afford to pay for long-term care should that event happen, but I am here to say have a plan in place and know what that plan is. Make sure that your family knows what that plan is. And to know that there are options available for long-term care that are beyond the traditional long-term care insurance, which is what most of us think of, that use it or lose it. My premiums are going to increase forever. It's hard to use because you have to be in a nursing home. There are newer style long-term care policies that are, they're what we would call hybrid policies, where you do still have a death benefit associated with that. So know that there are other options to explore for that leverage. So, that's really an area that is important to have a plan in place. The worst time to put a plan in place is when you need it. So know what that plan is, and make sure that your loved ones know what that plan is as well. So that's all I have for you today.
And I just have a few questions here. We have some time left. Mike, a lot of our clients that are business owners may not know who they want to give that business to, or if they want to sell the business. Can you talk a little bit about how planning can help? And it's still flexible enough that if life changes, they've got some different options on that, whether it be you pass it on to the one child, or you sell it outright, or, how that works.
Sure. Yeah, very common, in terms of, trying to help identify ultimately what that plan is for the business. But I think it goes back to what I was saying before, that starting with a core financial plan, so a core personal wealth plan, to really understand your goals and objectives, assets and income sources that you have, and ultimately what those goals and objectives are going forward. So, again, how does the business, what role does that asset play within the construct of the overall plan? So if it is a third party sale type transaction, what does that look like? Ultimately, what assets would then come into the business or potentially be reinvested, into the next venture. Very common that individuals are unsure in terms of what that next chapter holds for them. So, again, keeping some capital available, should they choose to invest in a new business. If it is transitioning to family, again, what would that look like? Ultimately, is there some equalization, as Sarah alluded to, that has to take place or needs to take place ultimately within the construct of the overall plan and ultimately the estate plan? So again, I think it just starts, Jane Marie, with understanding and having a good, solid personal financial plan in place, as related to one's goals and objectives, and ultimately what that asset is, what that business is, again, relative to the overall plan.
As cycles change, right? Right now, we're in the stage of, if I inherit, from my parents, let's say it's the last parent to pass away, an IRA, I have a 10-year window now to take that IRA asset, and it's kind of putting ordinary income on top of my ordinary income, right? Can you talk, Sarah, a little bit about how conversations you're having right now with people that have really overfunded, right? I mean, they've done a really good job of funding their 401k and IRA, but they're facing R&D issues. And is there anything from a legacy standpoint they can be thinking about and talking about right now?
Yeah, absolutely. One of the things that we talk about is called an IRA max, which is where, we have a situation, maybe there's a large qualified asset out there that you don't need. The sole purpose is to pass on to your loved ones. But you don't want to necessarily put them into the higher tax bracket, as Jane Marie is mentioning here. When you have $1 million or $4 million, or you name the number, when that's compacted to be passed down in a 10-year period, it's going to bump them up into a higher tax bracket. So one of the things that we will do in that situation, again, and this really only comes into play when you don't need it and have no intent for using it for income for yourself, we will actually stretch that, $1 million, if you will, out over a 10-year period to fund a life insurance policy. And then what that does is it is at that point going to pass on for more leverage. So that $1 million might get you $3 million of a tax-free death benefit. So now you've eliminated the increase in their tax bracket and passed on even more leverage to them through, again, what we call an IRA max.
Yeah, maybe if I could, I'll just add on to that from a planning perspective too. We're working with individuals. Now the required minimum distribution age has increased over the past couple of years from age 70.5, now to 70, 72, and ultimately 73, here going forward. And so again, there's some step ups there in terms of when that first distribution has to be taken out of an IRA or any sort of qualified plan asset. So is there charitable intent? If there is charitable intent, those assets make a great use, again, because of the ultimate taxability that it has to an individual, whether it's the IRA owner or a beneficiary. So again, if there's charitable intent, one can use an IRA or a qualified plan asset to transfer direct to charity via qualified charitable distribution that is income tax free. So again, you're satisfying charitable intent using what would be a taxable asset in a way that you're not paying income tax on that ultimate transaction. So again, working with a lot of individuals in that perspective, and then also doing some Roth conversions. So when it makes sense to maybe pay a little bit of tax right now at one's current income tax rate, converting some of those assets again from a traditional IRA, 401k, or any type of qualified plan, pay tax now at today's rate versus potentially a higher tax rate that one would have in the future. And then goes back to what Sarah was saying too, in terms of ultimately trying to generate tax-free income. So again, is there some sort of IRA max type scenario that we can utilize, and maybe some Roth conversion planning along with that to help generate that tax-free bucket, if you will, for either tax-free income or ultimately passing that asset income tax-free to one's beneficiary.
Maureen, sometimes we have a commercial client, a business client that comes in through the bank that's strictly business and talks about not necessarily having all their eggs in one basket, right? They want the personal to be on the other side somewhere else. Can you talk about some of the benefits of you have that business relationship and having a strong personal relationship with your banker and their team, and the benefits of having that, especially in market times like this, 2008? Why is it important to know your banker?
Well, I think that's a great question, Jane Marie, and honestly, one that we get rather often. And I would say there are multiple benefits of having a private banker on call. One is the knowledge of you and your family, so that if situations arise or change, your banker is on speed dial and someone that can react quickly, not just 8 to 5, Monday through Friday. Secondly, that will make great recommendations for you and your family and really provide those customized solutions to you and your family, whether it's from a mortgage for a primary residence, a second home, helping your children with their mortgages, and really being that point of contact for you. It's become very important. And, you know, so often in life, there are often transitions, and I think having that consistent presence of your banking relationship becomes that stability that clients are seeking.
And you do a great job of advising clients to have an updated personal financial sheet every year, updated balance sheet on the businesses. And the beneficiary piece is really an important piece of that, because usually there's a rogue IRA out there long ago. Can you talk a little bit about how you help every year, kind of just making sure that that's created and out there as a tool?
I think one of the things we look at whenever we are meeting with a client is how are the accounts titled? Do we have beneficiaries? Perhaps asking if the trust is a beneficiary on an account. Has that been updated so that we can have the most updated trust listed as a beneficiary? Do they want to make any changes to the beneficiary? And obviously, you know, in a year like this, having additional beneficiaries on accounts becomes even more important, particularly if clients have concerns that center around FDIC coverage. So I think it's a really important consideration and should be a regular part of your conversation with your bank.
Kids seem to be a big topic, a lot of clients, right? There's one rogue kid maybe out doing their own thing or kind of off the beaten path. There's a big population of families that are struggling with this crisis in the opiates and drugs or alcoholism. In the private bank, those types of things are very quiet, but it's important to plan and share. Just like you mentioned, kind of going to the doctor and saying, I'm laying it all on the line. Mike, can you talk a little bit about, what you're seeing high level as far as it's okay to have those conversations and not have the answers with kids? And Sarah, maybe can you elaborate as well on kind of just families struggling with structuring things, knowing that there may be a child out there that they want to equalize, but there's issues.
Sure. Yeah, I think it just starts with good general planning, and potentially having some trust planning in place as well. where maybe you're ultimately in that sort of situation, trying to protect the individual from himself or herself. And so, again, it's very customized within trust planning, to be able to have structure and to be able to provide specific instructions in terms of income, in terms of dispositive provisions, whatever that might be, in terms of ultimately how, an individual would have the access that they need, to a pool of assets. So Sarah, I know there's some other tools as well, as related to that, but oftentimes, Jean Marie, again, we find that a trust serves well in that purpose, again, to clearly identify and maybe restrict, access to assets in that regard.
Yeah, and really the only thing I would add to that is, there's certainly different types of trusts, special needs trusts. There's for children that have special needs. It's all in the language within the trust. I mean, the life insurance is the tool, the strategy, if you will, that's going to fund that trust. But it's making sure that that trust is set up to spell out exactly what you want to have happen and when.
Maybe one other point with that, it speaks to here, Fifth Third, again, we can act as corporate trustee. And so oftentimes, in a family situation, again, different family dynamics apply. And so to have a corporate trustee, such as Fifth Third, serve in that capacity as an unbiased third party, if you will, in terms of interpreting what that trust says, and then ultimately, again, kind of going through in terms of requests, distributions, etc. Not to mention, again, all the legal filings, tax filings that go along with that. But again, kind of taking a family dynamic, out of the mix, which again can be challenging in those types of situations.
I'm gonna piggyback off that because we've seen a trend of, it used to be that usually banks were all the corporate trustees, right? Or the attorney, the estate attorney offices were corporate trustees. And it's kind of got to be where, okay, I'm gonna name this one child that's really good. They have an economics degree, and they're working in New York. And really, I think some of the conversation we're having is, are they gonna have time to do that? And again, like you said, are they gonna be able to sit around the table and say to their brother or sister, you can't have that? So can you expand a little bit about the benefits and what you're seeing? That people are really going back to kind of that corporate trustee to eliminate some of that, because kids are all over the country now, living their own lives.
Yeah, absolutely. Again, in terms of the role of the trustee or even the role of an executor, it can be overwhelming.
Mhm.
And so, again, in terms of a family member serving in that capacity, again, with other family dynamics involved, not to mention their own personal time, again, can be very overwhelming. So to lean on a corporate trustee, to do that work, again, both from a filing standpoint and then also in terms of ultimate interpretation and distribution of those assets, can be not only time saving, but also can alleviate, again, a lot of, different family issues that can arise when, say a sibling is serving in that capacity and ultimately controlling, or deciding, and interpreting that trust in terms of having access to those assets.
I have one more question before we turn it over. Maureen, we work as a group of advisors, right? So we have national resources and we have the private bank, we have trust attorneys on staff here locally that really help private bank mortgage officers, depending what's going on. Can you talk about the benefits of having a team versus, we laugh sometimes and say, when we get around with our clients afterwards and have conversations on strategy, we're not bobbleheads, where we have no problem coming. But can you talk a little bit about the benefits of really having a team of people on as advisors, even if you have an outside advisor, kind of still incorporating the CPA and the attorney and everybody as kind of your board?
Absolutely. I think we like to say that we don't believe that one person can successfully wear all of those hats to be the subject matter experts on all of these topics. And just even thinking about the topics that we've discussed today and shared with you. So we believe that by having deep expertise in each individual line of business, whether it's planning or risk protection, or on the banking side or on the trust administration side, we bring the best to the table, so that we can provide that level of expertise and coordinated advice, so that we give our families the very best all the time. And not relying on just one person's advice. And we feel that's very important. And we've had that feedback from our clients. They find that very valuable and very different than what they may have experienced with previous providers.
And it's okay to have that second opinion, Mike, that you'll see a lot of times people have an investment firm out there that someone may have a relationship with. It's the college buddy or the neighbor or the golf buddy or, whoever. And we review that and it's a great brokerage account, right? It's a great investment. So it really is about kind of getting a second set of eyes and how everything works together, not necessarily poking holes in everything that's out there, right? And it's the tweaks that can help be more efficient in what your resources are.
Yeah.
And I think, Jane Marie, I'll share an experience. We were working with a client. It was a second marriage for both the husband and the wife. The wife had 3 children from the first marriage. They had 1 child together. And the husband's brother was the financial advisor. And the wife was not happy with the financial advisor. The husband was willing to entertain other advice and engaged with us. And really, we were able to put their minds at ease, because if the wife is unhappy, that's a difficult dynamic. They did not want to name any of the children to be trustee for the very reasons that Mike had outlined, that it would create disharmony at the Thanksgiving table. And by naming us as corporate trustee, harmony could reign. They had the peace of mind that they knew that the bank would be handling those conversations and making those dispositive provisions when something happened to them, and that they were receiving unbiased advice from someone who did not have a family connection.
Great. So I do have a couple questions. I'm also going to pull up all of your contact information so people can see that while we're finishing up here. Make sure that's sharing. Okay, great. What makes us, so business owners, a good client for you, and how can we do our part to be a good customer?
Is that a plant question? That's a great question. I'll take that, and Mel, maybe you can piggyback off that. I think really any client, and what's so great about, Fifth Third, and there's a lot of institutions that are really great, but we really work as what we call one bank. We have a core team, but we also have auxiliary teams that we work with. So you might come in and talk to us about your business banking, and we have a business banker, we have a commercial lender on that, and then they bring in the right team for that. It's never the client's responsibility to figure out who I call. So we always kind of work on that, kind of vet out who that is. So I think for being a good client is just sharing that, what's going on, having those conversations when we call to say, let's just sit down and have a review and see how business is doing, how your personal life is doing, confiding in us what is going on. The more that we know, just like going to the doctor, the more we can help with that and say there are different strategies, or we have heard of this before. We kind of joke that we could write a nice sitcom or book on some of the things we've heard, but again, it's the private bank, so it's very private, but we've heard a lot, we've seen a lot. Sometimes life can be messy. So if you can share with us what you're struggling with from a business perspective, even a personal perspective, then we can help me say, here's some resources, here's some tools that may help prevent those future risks that we're concerned about.
Yeah, I would say, Jane Marie, absolutely concur. The more you can share with us, the better advisors we can be for you. And as Jane Marie said, we've heard a lot from our clients. So when clients are with us, it is very much confidential, but we cannot give our best advice if we don't know what is going on in your personal life, your family situation, or even the things that may be on your mind regarding your business. So the more you can share, the better advisors we can be for you.
And I think working with your CPAs, your attorneys, we really enjoy doing that because again, you've got their level of expertise. We don't draft documents. We don't do any of that. So again, if we're making recommendations in the planning, we're reaching out, making sure that those trusted advisors are included in that as well. So I think it's a benefit for everyone involved.
Great. Another question we have is, how much runway is typically needed to transition a medium-sized company to the next generation in the most efficient way? 2 years, 3 years, and anything like that?
Yeah, it's a great question. And I think the 2 to 3 year mark is a good ballpark. I mean, certainly the earlier the better is always the answer to that question. But inevitably, again, trying to set the business up and structure the business properly. If it is a third party sale, again, to optimize value. And if it is a transfer to family, to the next generation, trying to make sure that that individual is comfortable in that role, trying to make sure that, again, depending on the size of the business, that the staff is comfortable ultimately with that transition. So I think the more advanced planning that can be done, the better. Again, to ultimately prepare for a successful transition. A lot of times too, it's what is that exit plan then for the business owner? So if it is a family type situation, does the business owner stay on? If so, in what capacity? If it is a third party sale, again, does the business owner stay on? Again, in terms of customer retention and ultimate succession of that plan, what's that structure look like? So again, the more advanced planning that can be done, the better. When it comes to the ultimate taxation of that sale, if we are talking about the sale, some sort of sale, whether it's third party or whether it's to family, again, advanced planning is paramount to be able to, again, stay ahead of that transaction, to do some planning at an arm's length, if you will. Again, prior to that transaction ultimately taking place, if we are trying to save on the tax side.
Great. Another question that kind of goes off of that same one. Are you seeing any creative ways that the next generations are using to buy their family businesses?
Yeah, that's a great question. Again, if it is a situation where maybe the business isn't being gifted, but instead is being purchased in some capacity, there's different types of trust planning. One that's very common is an intentionally defective grantor trust, whereby there's a note back to the business owner that, again, that successor, that business pays a portion over a period of time. So that's a tool, that's a strategy that's very common in that sort of situation. It could just be structured over time where maybe there is some gifting that goes along with that ultimate purchase of the business. So a variety of different ways that can be structured, but I think, again, the most popular and the most that we're seeing, again, is via that intentionally effective grantor trust.
Great. And then just one final question that we have. Can you share some advice on what smaller businesses can do to help secure capital?
We can grow your business, right? And I think it really goes back to, that's a great question. It goes back to having that relationship with your banker, your business banker, your commercial banker, your local banker, of how credit is right now, how you forecast credit. You'll hear from the Fed what the senior commercial creditors or, the credit lenders are looking at, and there's talk about credit squeezes and what that looks like. It really varies by institution and what, again, it's a commodity. What's the appetite right now? So I think it's having that conversation of, hey, we're in a squeeze right now. Is there available credit? What do we need to do to look at that? And then having that conversation in the good times as well, saying, do we need to prepare for the future and those squeezes that are coming down? Because, we talk about all the time having lines of credit available in place, even if you don't need those. So I think it's having those conversations and having them frequently, and not just, hiding away when things get a little bit tough, is knocking on the doors. And, business banker and commercial should be doing that as well, hopefully.
Great. Well, that's all of the questions that we had. If there's any final wrap up things that you guys wanted, or if Angie, you had anything. Okay. Well, thank you guys so much. Thank you to Maureen, Jane Marie, Sarah, and Michael for joining us this morning. Again, this was recorded, so we're going to put it on YouTube. We'll also have it out on our social media once we have it posted. Angie was also live tweeting, so if anybody wants to check that out. But other than that, we hope that everybody has a great rest of your day, and thank you guys again.
Thank you.